for young people looking to get into this industry, seek out places where you are in fact different, where your background is different, where you're from is different. I'm from Florida. Like, making it to New York City was a bit of a grind. But the idea being is that if you can be different, if you can stand out and work hard and be good at what you do, you can be remembered.
Welcome to Private Capital Call, the podcast with leaders in asset management, investing, and capital markets. I'm your host, Randy Schwimmer. This month, we're pleased to welcome Cameron Dawson, Chief Investment Officer at NewEdge Wealth, a division of NewEdge Capital Group. NewEdge Wealth provides tailored resources and solutions for ultra high net worth individuals, family offices, and institutional clients. As CIO, Cameron leads the development of the firm's investment themes, strategies, and market outlooks. Cameron, it's so great to have you on Private Capital Call.
Wonderful. Thank you so much for having me.
So one of the things that would love to get your feedback on and insights is the difference between wealth clients and institutional clients. What are some of the characteristics that you find in your company that, and maybe they're idiosyncratic relative to our large institutional clients, that your wealth clients share?
It's so very important because when we talk with asset managers throughout our platform, one of the things that they realize is that the wealth channel is one of the areas of potential growth. If you look at institutions, many institutions are fully allocated to private markets, and even some are pulling back. So they look at wealth and say, look, a lot of these clients, even though they are large and sophisticated, they may only have 5-10% within alts. And we think that that has room to move higher. But that doesn't mean that you should treat an institutional client the same way that you would treat a wealth client. And there's some really important key differences between our group of clients and what you would typically have with institutions. And it's best to think of them effectively as constraints. So the first one is taxes are really important for our clients. Our clients are predominantly in the highest tax bracket. Their assets are predominantly taxable. And that is a real constraint when we're making and building portfolios. We're always thinking about tax efficiency. So if there are parts of the portfolio where we can optimize for tax, so that way we have effectively budget to pay taxes in other areas, we'll think about that in a very strategic way. The other one is that wealth clients can have surprise liquidity needs. This is very different than institutions, which typically know what they're going to have to spend each year. But an institution like an endowment or foundation is very unlikely to call up their asset manager and say, hey, sell everything, I want to buy a boat. But we get those calls. So we have to think about building in liquidity needs into portfolios. So just as we're optimizing for tax efficiency, we'll optimize for liquidity efficiency. The last one is really important, and it gets into a behavioral side of things, which is that people act differently when it is their money versus somebody else's money. And sometimes we see it even with clients that they might be part of an institution and then also have individual money with us, that you can see an emotional change in how people treat their own capital. And what that means is that education becomes really important. I'm sure we'll talk about this a lot when we dive in deeper. But you have to know what you own and why you own it. It's a mantra that we always repeat, and that allows in times of volatility and uncertainty to not get skitterish when emotions typically pick up. So those constraints of taxes and liquidity and emotions are something that really makes the wealth channel very, very unique compared to what you see with most institutions.
Now, I see you on a lot on great media appearances talking about the public markets. Private credit, private capital is a different animal. And particularly as we start to think about overlaying that into the wealth channel, how do you fit private credit into these conversations with these clients, given the constraints that you just mentioned?
Well, I think it's important to start from our view and look at private markets or public markets, which is the starting point is that starting points matter, and that it's a very different setup for forward returns when you have a market that is trading at 9 times earnings, you have generational low allocation to equities, and you have the wall of worrying being very high. I'm effectively describing the situation or setup in 2010. You compare that setup where forward returns for over the course of the next couple of decades or decade and a half were above average to the extent of nearly double what you got in a long-term return. You had these huge returns because you were having the starting point be so very low. You compare that to today, it's the effective opposite. You have an environment where S&P 500 is trading over 22 times. You have near generational highs in equity allocations. You have the wall of worry being what we would see is fairly low at this point, a lot of optimism. And that sets up for a potential environment for lower forward returns in public markets. Now, that doesn't tell you exactly the path that markets will take to get to those low forward returns. So we're not saying that public markets can't rally. But what we're arguing to clients is that that means that you have to look for other opportunities to make your return goals. So this is where something like private credit, as well as other private assets, come in. Because what we argue with these asset classes is that there are more structural benefits that can be a driver of returns. More asymmetric information, more ability to take advantage of big structural changes in the way that capital is flowing. It's more about manager skill versus the rising tide that's lifting all boats. Mm-hmm. And so if you can identify those managers, then you have the opportunity to still meet your return targets, even in a lower return world. And I think that what that creates as a challenge is that if you look at the dispersion between the top and bottom decile in public markets, it's very, very small. They're efficient markets. It's all been competed away. But as you move into private markets, the spread between the top and the bottom decile starts to blow out and widen significantly. So it puts the onus on people like us as sitting as wealth managers to do a deep amount of due diligence to understand the managers that we are working alongside, because the experience of investing in one asset class can be very, very different depending on the skill of the manager.
If you think about the macro environment that we're in, because we talked about education, how does that challenge you in explaining the benefits of private credit that you just mentioned, given the fact that we're in an environment where a certain tariff policy is laid out and then it changes at first for the better and then months later for worse, when you have issues with regard to the slowing of the economy and other things, inflation, does this make your job easier or more challenging?
I think that there are always challenges. It's interesting. Everybody will say we live in unprecedented times. The reality is all times are unprecedented. We've never been here before. We've never had a 20x on the tariff rates. We've not seen let's just say the post-COVID environment is so very different. We've never seen the degree of intervention into markets that we did in the COVID era that is still having these echo effects through markets. And one of the echo effects that I think it brings it back to the private credit landscape is that we do think that the 40-year bull market in bonds is over. If you were just going to look at the chart, you could look at the long-term chart of the 10-year Treasury yield, and it's no longer in a downtrend. And that means that you have to think about building fixed income portfolios, whether it's public or private portfolios, differently. You can't count on this ever march lower of interest rates just continuously moving lower and lower each and every decade, each and every year, which is what we were in from the peak in 1982, effectively to the low in the 10-year Treasury in June of 2020, where it hit 0.5%. Can you imagine
Amazing.
Back 0.5% of the 10-year? And so what we think that requires of investors is to think about utilizing things like floating rate, which a lot of private credit is based off of SOFR. So it's effectively a floating rate type of investment, utilizing that within portfolios. But then it also necessitates a lot of really, really strong credit underwriting, because in an environment where you can no longer count on this ever decline lower within interest rates, we think it starts to separate the wheat from the chaff in those higher quality credits versus low quality credits. So it creates the absolute imperative of selectivity.
And you mentioned education. Our friend Jess Larson at Briarcliff, who's been in our program, likes to say that the beta for private credit is returns. Alpha is really the education, the training of investors. What type of education do you think is primary? What are the kind of things that you talk about with investors about private credit that you think they really need to know from a retail perspective?
I think the first one, and this is something that's led by a fantastic colleague of mine named Chloe Reed, is that she's absolutely insistent that when we talk about private credit, we talk about it on a spread basis and not on an all-in yield. So we'll always say this is your spread to SOFR. That's important because what we don't want clients to do is get anchored to a certain yield because of where the Fed funds rate and where SOFR is today. That anchoring, if it's not managed properly, meaning we're not setting expectations properly, can be dangerous because when the Fed cuts rates, which eventually it will in some kind of cycle, that we don't want clients to look and all of a sudden say, oh, I used to be getting so much of a yield on this instrument. and then all of a sudden I want to sell it at a very inopportune time, because we always have to think about then the context as to when the Fed is cutting rates. Because if the Fed is cutting rates because it can, meaning that it's cutting rates because inflation came down, but the economy is fine, then you probably won't see credit issues pop up in some of these private credit portfolios. But if the Fed is cutting rates because it should, it means that as the Fed's cutting rates, you could start seeing some credit issues start to pick up because the economy is under more strain, which means that would be a very inopportune time to be selling out of an asset class which you should have a long-term perspective on. So that's step number one. And the next step is what we talk about in the quality of underwriting and making sure that we continuously align with managers that are seeing this as a through-cycle investment. Because we've seen a lot of new entrants, as you well know, probably better than anybody, into this space, and some of them are not as disciplined as others. So it's not about maximizing yield and return and spread today, but it's maximizing it through a cycle, which means that we may give up some yield today in order to stay in the higher quality spectrum, but we think that overall through a cycle that will win out because of that discipline.
So one of the mistakes that investors make, I think, is to look at the liquidity that's inherent in the public market and feel safer. And yet, ultimately, when the market trades down, as we saw in 2022 as an example, everything trades down together. So all liquid assets, turns out, are all correlated in a negative way. How do you describe the risk-reward dynamics when you talk about privates, given the advantage that privates have in that kind of market, when all the liquids are trading in one direction, usually down, to compare the opportunity in private credit, which allows some stability and diversification?
Yeah, so we like the ballast of not having the constant mark to market. Now, we're not so naive to say that there aren't strains within portfolios, Cliff Asness and the volatility laundering, and completely acknowledge that. But it can be a very important kind of stability function within portfolios, knowing that the other important part to come with that stability is that private credit has the ability to insert itself and effectuate change and come up with solutions for its underlying holdings because of the control aspect that it has, meaning that it's not completely outside of the control. The market isn't just setting this price, which means that whether we're thinking about it in terms of workout teams, which it doesn't get there all the time, or the ability to find creative solutions when problems do arise, that can mean that losses aren't realized. I mean, the worst thing, and this is a very general statement, and I think it applies to all portions of a portfolio, is that the worst thing that anybody can do in investing is sell at the bottom and be too scared to get back in. And that often happens with highly volatile assets that get swung around in these mark-to-markets. And we had the experience, of course, if we compared the performance of high-yield bonds in a year like 2022, or even in times like just what we had earlier with Liberation Day back in April, that you had much more stability within private credit that was a ballast within portfolios. So having that understanding that you have the stability is something that clients really do like, because you don't get the same kind of statement shock. That doesn't mean that we should rest on our laurels and not talk to these managers at all times during cycles. And we do quarterly updates with our managers to make sure that we're comfortable with where the underlying portfolios are. But statements do matter.
So when thinking about that response from an investor perspective, what in turn is the biggest challenge that private credit managers have when trying to access this market?
I think it's the crowdedness of the space is probably the newest challenge over the course of the last couple of years. And you, as very early movers and pioneers in this space, have been probably on the front lines of all of this capital flowing in and all of the emergence of these new managers. Of A, how do you differentiate yourself? And B, how do you make sure that you have discipline through the cycle? And we know it's sort of like the old Lake Wobegon, where every child is above average. Every manager will always say, well, we only invest in acyclical companies that are the highest quality and they're not sensitive to the underlying economy and they're the best companies ever. And that's all we do. And we know that there are managers that have that discipline, but the degree of growth in the space would suggest that there are pockets of lower quality credit that has most certainly crept in. And so I think that it's really, really important as we're talking with managers to talk about their discipline process, talk about their underwriting, how they see downside risk emerging within portfolios. Transparency is also highly, highly important to us. We want you to be upfront with us. Tell us when there's credit issues within the portfolio, even if it's one-off, because as we say, if you don't tell me that it's a one-off explicitly, I will extrapolate. It's my job to extrapolate. So we think that transparency and being very forthcoming about what's going on within portfolios is a key input in how we choose our managers.
So talking about private credit in the current environment, and we're sort of mid-July, thinking about what the second half of the year is going to bring, what are the things that you think investors don't understand as completely as they should about the asset class and some of the benefits in an evolving environment, particularly, let's say, in a slow growth environment, which potentially could be in? Are there things that you think are important in this education process to explain to investors about things that they should be able to lean into for an illiquid asset class that does theoretically have a risk premium to it relative to the public's, and where active managers who hold the assets for long periods of time are basically saying, look, we've got the risk asset. We're going to control that risk from our perspective so you don't have to worry about it.
I think we'll be talking a lot about bank regulation over the course of the next 6 months, 12 months, and how that could potentially shift and change the environment for private credit. That will be an important watch item, which is that if all of a sudden you've released a lot of capital from the banks, do they start to become more competitive? We're watching spreads really closely as we look at, if as a proxy, things like CLO spreads and that they've been at record tights, wanting to make sure that for the risk that we are taking, that we are being well compensated, which means that when spreads are this tight, we'll lean more into quality providers versus reaching down in credit quality in order to just maximize yield. Again, we're investing for through the cycle. We're also watching really closely the development or kind of the progress of the health of the U.S. labor market, really being the linchpin in all of these discussions for the U.S. economy. As we think about the next 6 months, we've seen this U.S. labor market continue to be so resilient, and that if it starts to weaken, are you invested with private credit managers who have the flexibility to come up with solutions if sales slow, if EBITDA slows in a more meaningful way? We've been in an environment where the underlying investments have remained extraordinarily strong. There's been idiosyncratic challenges, but you're still in a strong nominal growth GDP environment, which means that you can lean into risk. But we want to make sure that if that starts to slow in a more meaningful way, that we understand the downside. But default rates are still really, really low, which means that managers are taking advantage of the control that they have to come up with solutions for these companies, even if those that might be running into a few challenges here and there. And tariffs, I'm sure, are a big source of headaches for these kinds of companies.
So, Cameron, one of the things that we like to end on with these interviews, and we do it for our lead left guests as well, is to talk about how you got into this career, this crazy career of capital and allocation asset management. And what advice for those who are listening? We have many people who listen to us and think about asset management as a career goal, and some are in college looking to get out, and some are frankly mid-career in things like banking and other areas thinking, boy, this asset management thing looks like a high-growth, exciting area. What kind of lessons have you learned as you've evolved your career into what's obviously a very successful platform in talking publicly and in the media about this? What kind of lessons have you learned, and what advice do you have for people who are looking to get into this crazy business?
Yeah. Well, first of all, it is the most fascinating business, and it is an absolute thrill and an honor to be able to be on the front lines of understanding markets. I pinch myself every day. I think I have the coolest job in the world. And in that, one piece of advice and something that I always remind myself of as I look back is I realize that I've never been fully qualified for any job I've ever had, but I did know this. I did know I had the capacity to learn and to learn quickly. And that is something that as a student coming out of school, that's what you are learning in school. It's not all of these detailed hard skills of executing on this Excel spreadsheet, that Excel spreadsheet. We're in the age of AI and rapid technological change. A lot of those skills will become obsolete very, very quickly. But what won't become obsolete is your ability to learn quickly, to be autodidactic, to be very self-teaching, and to be able to adapt quickly to new environments. And what that creates is an approach to a career, which I would say is high humility, low hubris. That's really powerful because you go and say, okay, I may not know everything, but I'm really hungry to learn. At the same time is that I don't have this overinflated sense or idea that I'm fully qualified on the way in. So it keeps an open mind. The last one I think is really important, and something, as you know, I was an industrials analyst. And so I spent most of my time in conference rooms and be me and like 40 dudes. And I looked very different than everybody else in the room. But I think that worked to my favor. And I think that for young people looking to get into this industry, seek out places where you are in fact different, where your background is different, where you're from is different. I'm from Florida. Like making it to New York City was a bit of a grind. But the idea being is that if you can be different, if you can stand out and work hard and be good at what you do, you can be remembered. It's like swimming downstream with the current at your back. So if you look around and say, well, there's not a lot of people who are like me doing what I do, good. Lean into it. Be accepting of that because it actually can be transformed into a superpower.
Cameron Dawson, Chief Investment Officer at NewEdge Wealth. Thank you so much for joining us on Private Capital Call.
Thank you for having me.